Hello all, welcome to this new quarterly webinar session. We are going to wait 1 minute to let more people coming in. So welcome to those who just joined. It's now time to launch the second EnergyScan webinar session of 2024. I'm Julien Waro. I'm in charge of the economic research team here at ENGIE Global Energy Management and Sales. So we have seen a significant divergence in energy prices over the past few weeks, with oil and coal prices increasing on supply concerns and resilient demand. Natural gas and energy prices stabilizing and then rebounding a bit after a sharp downward move. And European power prices plunging on a combination of higher nuclear generation in France and a further penetration of renewable assets. So in this session, we'll give you the key elements to understand if this trend could be sustained in the coming months with our speakers, namely Olivier Gasnier, Évariste Nouki, and Étienne Covin. So as usual, check out the buttons on the bottom right corner of your screen to ask questions to our speakers or chat with participants and leave suggestions to the team. We'll do a Q&A session at the end of each presentation. And I remind you that the session will last 90 minutes to take as much questions as possible, so until 11:30 a.m. So finally, you will be asked to fill a one question satisfaction survey at the end of the session. The slides and a replay of the session will be available by tomorrow at the latest on the EnergyScan platform, but you can already download the slides by clicking on the cloud icon on the top right corner of the screen or following the instructions displayed here. So click on apps, then handouts, and you should see the PDF version of the slides. Before we start this presentation, we would like to thank you warmly for your votes at the Energy Risk Commodity Rankings, which are a yearly market survey recognizing companies that excel in the global energy market. EnergyScan has been ranked number 1 for natural gas, power, and emissions research for the first time this year. So this is an outstanding result that illustrates the level of continued trust that you have placed in our market analysis service. So we are really proud of that and truly honored by this recognition. So thank you all for that. So it's time to move to the first part of this session with the macroeconomic and oil outlook with Olivier. Let's start as usual with a one question poll on a very hot topic for macroeconomic observers. So I don't see.
I think that's okay, Julien. We see the poll.
You see the poll. You see the poll.
Yeah,
Okay,
yeah.
I was just wondering. So, which central bank do you think will cut rates first in 2024? Will it be the Fed? Will it be the European Central Bank, or neither? So, thank you for answering that. So we clearly see a majority of you guys answering the European Central Bank, which is something, of course, that will be commented by Olivier, and we'll see if macroeconomic figures support that assumption. Just to give you something about the poll we provided 3 months ago. We were talking about the number of rate cuts, and now we are just talking about the possibility to cut rates. So clearly a lot happened over the past 3 months, and I'm eager to listen to Olivier on that. So thank you all. I'm just going to unpublish the poll. And so we can start with the macroeconomic and oil outlook. Olivier, the floor is yours.
Hello, everybody. Thank you, Julien. So if you remember from our last webinar in January, the markets were looking forward to a rate cut, as Julien just said. 3 months on, only the Bank of Switzerland has cut rates among the major central banks, and the road to that cut is full of pitfalls. So this morning I'm going to frame my presentation around 3 questions. What are the growth prospects? The first one. Second, has disinflation grown to halt? And the third question will take us to commodities. What is the outlook for oil prices, as a sharp rise would really complicate the task of central banks. So let's start with growth. And we'll start with in a way, the exception that proves the rules, as China is not fighting inflation but deflation. Many even believe that it could follow the same trajectory as Japan, which is trying to emerge from almost 30 years of deflation. As you can see, Chinese GDP grew by 5.3% in Q1, but this masks a fourth consecutive fall in prices. As you can see, the difference between the nominal GDP and the real GDP. Private demand is not picking up because the property sector has not emerged from the crisis, and consumption has not picked up as expected after COVID. You see that retail sales have constantly been lower. Their increase has been constantly lower than the variations registered before the COVID crisis. Even industrial activity seemed to weaken again in February and March. So China would like to rely on its exports again, but it's facing increased protectionism from the US and Europe as well. And of course, it will be worse if Mr. Trump returns to power. So for China, unconvincing growth and worries for the future, I would say. So what about the Eurozone? The PMIs show an improvement in services, and that has been confirmed a few minutes ago. I don't have the Eurozone numbers, but what we have seen for France and for Germany was that the services sector showed an improvement, but it was still very difficult for the manufacturing sector. So that could lead to a return to growth, and that has been at a standstill since the end of 22. However, if you look at other surveys, they are not as optimistic, and above all, this improvement is not widespread, but concentrated in the countries that have received the most European funding after the outbreak of the pandemic, that is to say Spain, and especially Italy. And we might add that the time has come to get public finances back under control. And you know that this is especially true for France, which increases the need to lower interest rates. Let's turn now to what interests us the most, because this is what determines the level of interest rates to a large extent. And I'm referring, of course, to the state of the US economy. After a somewhat difficult start to the year, the growth forecast for Q1 has risen sharply to approach 3%, according to the estimate provided by the Atlanta Fed on the basis of available data. So, of course, there are some signs of deterioration linked to the impact of high interest rates, particularly on small businesses or the property sector, which are financing themselves more through bank credit. The labor market also appears less tense, but the main US economic indicators remain very good, with in particular the US manufacturing indicator that has just risen above 50, and the job creation that is continuing unabated. At the start of the year, in a way, the market were expecting a soft landing for the US economy. They are now convinced that there will be actually no landing at all. And of course, that has consequences for inflation on monetary policy. So we now start the second part of this presentation about inflation. Generally speaking, inflation has remained high everywhere except in Asia, and the recent trend is not good because of oil prices, on which we will come back a bit later. The breakdown of US prices on the graph on the right shows that energy prices, which were pulling inflation down in 23, are now pushing it up again. There is a basis effect, and of course the fact that oil prices have rebounded. Above all, however, we can see that service prices are no longer slowing, which explains why core inflation is virtually no longer falling in the US either, as you can see on the graph on the left. Whereas it's slowing less quickly than expected in Europe, but nevertheless, it's continuing to do so. In the Eurozone, core inflation has fallen below 3%. In March, while in the US it stood at 3.8%. This divergence in inflation path is reflected in the outlook for monetary policy, since the Fed made it clear to everyone in December 23 that it was going to cut rates in 24. Market expectations, as you can see on the graphs, have changed considerably. Of the 6 Fed rate cuts anticipated up to the end of January, there are only 2 or even 1 remaining. The second one, it's about 50-50. By the way, I really must congratulate you, because when we asked you this question in January, 70% of you expected only 3 rate cuts by the end of 24, and 25% of you thought there would be no cuts. And I have seen your answers for the question we asked at the beginning. There were still more than 20% of you thinking that there will be no rate cut by the Fed and the ECB. So it's very consistent. Only 5% of you agreed with the market scenario. So I modestly hope that I can influence, I have influenced a bit your answers for these questions. The first cut was expected in March for the Fed. Now it's more likely to be in September when we look at the forward curve. And some Fed members are beginning to raise the possibility of a rate hike instead. And by contagion, but also because of the slowness of disinflation, expectations for the ECB have fallen from 6 cuts to 3 only in 24, but the first one would be in June. And so, given those change in expectations, bond yields, which had fallen sharply in Q4 23, whipped out more than 2/3 of this fall. If you remember, the US 10-year at the maximum in October 23 at 5%, it fell to 3.8% in December, and we are now back to between 4.6 and 4.7%, which is very close to this peak. Unusual divergence between the Fed and ECB rates has pushed up the 2-year rate spread between the US and Europe to over 200 basis points, which has strengthened the dollar against the euro, but probably not as much as we might have expected. So I think that the euro may weaken further. That is to say that we could see the euro dollar falling a bit further, probably towards something around 105. If the ECB actually cut rates before the Fed does, which could pose, of course, a problem because of the higher cost of imported goods. And this is why it's the ECB is reluctant a bit to start cutting rates before the Fed. So to sum up and to come back to our initial question on growth, it's possible that we will, in my view, gradually shift from a soft landing scenario in the US to a hard landing scenario, because I don't think that the no landing scenario exists except in dreams. The longer interest rates remain high, the greater the risk that something breaks, as we used to say. Is it credit or commercial property? At the very least, we expect the performance of the US and Eurozone economies to converge towards 1% plus 1% in 25, while the US outperformance will remain very strong in 24, but probably with a much weaker dynamic in the second half of the year because of the impact of high interest rates on activity. So I think that we have, before talking about oil, we have a second question, Julien.
Yes, exactly. We have a second poll. So don't hesitate to ask questions directly in the question module or in the chat room. So second poll on the oil market. Let me publish that.
Yes, we see it. Okay.
Okay, so at what level do you see the price of Brent crude oil at the end of the year? So is it over $90 per barrel, under $80 per barrel, or between $80 and $90 per barrel, which is its current level? I give you a few seconds to answer that. Okay, so there is a small majority for between $80 and $90 per barrel. But we see at least almost half of the votes above 90 or below 80, so quite a significant volatility. So Olivier, what do you think about that?
I see quite an upward bias, I would say, because 30% for over $90 per barrel. So it's interesting. Just half of people expecting prices to remain rather stable, I would say, between $80 and $90 per barrel. Okay, so about oil. So our usual chart about the historical prices, just to see how prices have evolved. So since January, our prices have risen by around $15 per barrel. As you can see, there has been three main factors behind this rise. First, continued output restrictions by OPEC plus producers, that is to say the vast majority of OPEC countries and Russia plus a few other countries. These restrictions will continue until at least the end of Q2 24. Second factor, a reassessment of the outlook for demand, notably because of the resilience of the US economy after a poor start. We have said a word about that, but also because of a strong demand for oil in China, despite persistently disappointing growth in domestic demand. And one of the key game changers for the market has been the fact that the International Energy Agency is now expecting a market short of supply on average this year. And, previously, that was the only agency expecting a market short of demand. Third factor, of course, geopolitical tensions. On the one hand, there have been Ukraine attacks on the Russian energy infrastructure. And then there was the Middle East return to the forefront with the resurgence of tensions between Israel and Iran. First, the attack on the Iranian embassy in Syria. That was really the trigger for the rise in prices. Then Iran's first attack on Israel territory. That was the very first one. And finally, Israel response that came just a few days ago. So as you know, things appear to have calmed down, as you can see, because prices have declined. On both Israel and Iran have tried not to go too far hence these falling prices. Nevertheless, I think we can say that a threshold has been crossed, that these countries, Israel and Iran, which never used to clash directly, but only via proxy, such as the Hezbollah or Hamas or the Houthi in the Yemen, have now done so. And this probably foreshadows a much more unstable geopolitical context in the region in the future, and the risk of recurrent spikes in oil prices. So to say a word about OPEC, OPEC, in a way, given the level of prices, seems to have regained control of the market by lowering its production quotas by 4.5 million barrels per day since 22. Well, the effective reduction has been much lower, but nevertheless, it has reached something around 2.7, 2.8 million barrels per day. You can see that on the graph on the left. But tensions are high within the OPEC because the countries do not have all the same interest. Saudi Arabia, for example, has considerably reduced its output to support prices. You can see that on the graph in the middle. Why? Because according, for example, to IMF calculations, the country needs prices above $100 per barrel to balance its budget. Whereas in the case of the United Arab Emirates, they need a barrel at around only $50 per barrel to balance their budget. And therefore, of course, they are really reluctant to lower that production. They just want to produce a maximum, and also because they have invested a lot. So you can see that actually there has been no effort at all from the United Arab Emirates. So I think that on top of that, you have several countries that are not respecting their quotas, such as Iraq, or are cheating, such as Russia. So OPEC plus production is probably likely to increase from Q3 24, and the last monthly report of OPEC has clearly opened the door to that. As for the countries that are not subject to quotas because they are under sanctions, such as Iran or Venezuela, the threat of additional sanctions brandished by the US is not very credible because the Biden administration cannot risk an oil shortage for obvious reasons. If you look at the combined production of Iran, Venezuela, and Libya is a bit different because of political instability. They are not submitted to quotas, but not because they are under sanctions. So this combined production has increased by almost 1.5 million barrels per day since the outbreak of the war in Ukraine, despite the sanctions still being in place. There has been just 6 months of easing of sanctions for Venezuela. It has just come to an end, but for Iran, the production has increased while there was no change in the situation. So I doubt that the US can really apply tough new sanctions on Iran, because that would mean, in the extreme case, losing 1 million barrels per day on the market. That would send oil prices above $100 per barrel. And you have the illustration of that for the US. Rising gasoline prices are a major issue in the forthcoming presidential elections. Forecasts suggest that the price at the pump could exceed $4 per gallon before the summer, and that would bring back the situation to 22, because US refiners are exporting massively to Europe, and stocks of petroleum products are falling in the US. So again, I think the US administration will do nothing to reduce world oil supply and reinforce those tensions on oil products. So now the final slide, the forecast on the equilibrium between demand and supply. As you can see from this table, and you need to look as usual on the stocks level. You can see that the market is now extremely tight, with a decline in stocks. That explains the upward pressure on prices, but that the situation should change, and that the market the situation should improve from the summer onwards, partly because OPEC production should increase, as I have said, and partly because the US demand should start to slow down. And these trends could strengthen over the next few quarters, if I'm right in my forecast, expecting a slowdown in the US economy. That would put downward pressure on prices, bearing a resurgence, of course, of tensions in the Middle East. And you have the results of all that in our forecast. And we think that the oil prices indeed could slow down, but still be above $80 per barrel at the end of 24, but probably fall behind this level in the course of next year. Okay, so I'm done. I think, Julien, I don't know if we have some question about this macroeconomic environment on the oil.
Yeah, a question for you, Olivier, regarding crude oil supply and especially the US crude production outlook. We have seen recent news and reports from shale oil producers announcing spending and production cuts. What do you think about that? What is the outlook for the US crude oil production in the coming months?
Well, the forecast is that the oil production should increase before the end of the year, but by not that much. We are talking about 100, 200K barrel per day before the end of the year. What we can see that for weeks now, we have seen a stable output. Absolutely no change, I think, for the last 2 months. But that was the case last year exactly at the same period, and we had suddenly quite an acceleration in the second part of the year. That can come also from the fact that the weekly numbers are only estimates, and they are very often quite different from the final monthly numbers that are based on effective production data, not estimates. So maybe the production has continued to increase since the start of the year. This is what I meant, because of the rising prices. It's certain that at these levels of prices, there is clearly incentives for US producers to continue increase their production. But there is also uncertainty linked to the outcome of the US presidential election. Of course, we know that a comeback of Mr. Trump would be much more favorable for shale oil producers in the US, while it would be much more difficult with a re-election of Mr. Biden. This is probably that could lead to some uncertainty on a kind of pause before rising really production further.
Okay, so we have a question in the chat room regarding crack spreads. So do you have any view on why diesel crack has broken below 21 euros, while gasoline crack is trending higher?
Well, there is also a seasonal pattern, which means that, of course, this is the end of winter, and refiners have more interest now to really to produce more gasoline, because the demand will increase. It will be the driving season in the US, but also everywhere. I mean, people will use their car to go on holidays, on weekend, on vacation, etc. Less eating, etc. So there is more demand for gasoline, and also, as I said, there is this problem of declining stocks in the US, because US refiners tend to export a lot towards Europe, which is a bit short of oil products, with of course the war in Ukraine and less imports from Russia. And so that tends to push gasoline prices higher. with higher margins for refiners. And this is something that is really a big problem for, I think, for the US administration, for Mr. Biden, and probably they could use strategic reserves of oil products this year to later this year to try to calm down these tensions on gasoline prices in the US.
Okay, thank you. A last question that concerns also the gas market, but I think it could be really interesting to have your thoughts on that, Olivier. So there is a rebound in European industrial gas demand. I think that will be commented by Évariste as well. So it's lower than the average pre-war and pre-energy crisis period. What are the drivers and which industrial sectors are responsible for the increase? And will we see a strong increase in the industrial sector for the rest of the year in Europe, Asia, and the US, notably regarding a potential interest rate cut?
So far, at the macroeconomic level, we don't see in Europe for the time being, and that was really confirmed by the first PMI I saw this morning in France and Germany. The level of activity in industry remains very low. There is no clear improvement. On the improvement for the euro area economy only comes from services. So in particular, if you look at the German industrial sector, which has been traditionally a leader of the European activity, it really faces big problems linked to the cost of energy, linked to the problems of the car sector in particular. And so, also the weakness of the Chinese demand, which was clearly one of the major markets for the German industry. So, at this stage, I don't see any evidence of a strong rebound in industrial activity, and more generally at the global level, there is no sign of a big improvement. It remains really difficult in industry for the time being.
All right. Thank you, Olivier, for your presentation and your answers. It's now time to move on to the second part of this session with Évariste on the natural gas outlook. We'll start with a small poll. So we can go to the poll module. And so first question on the natural gas outlook, and of course a key parameter for the coming months. What will be the European gas stock level at the end of the year? Will we be below 60%, between 60 and 80%, or above 80%, which was the case at the end of last year and the end of 2022. In 2021, December 2021, we were below 60%. That was just the beginning of the gas crisis in Europe. So we see a clear majority there, 70% of the vote above 80%. So a repetition of the scenarios of the two previous years. So Évariste, I'm waiting for your comments on that. And so let's start the gas part.
Thank you, Julien. Hello, everybody. So you'll see if what I present to you will be in line with what you expect. So we'll start with the European gas balance. Just to come back to what happened in 2023. Strong drop in Russian flows, but this was expected, the minus 36 BCM. Also, significant drop in Norwegian supply and also domestic production. This was not expected, but we can say that it was a risk factor, clearly, because in 2002, both Norwegian supply and domestic production was pushed to maximum because the gas was needed at that time. So a lot of maintenance work did not happen in 2022 and was postponed to 2023. This explained the drop. But overall, what we can say is that the decline in supply was offset by the drop in demand. And you have the numbers if you want to have them in percentage. The massive drop was significantly for power generation. Industrial demand was also down. Since the start of 2024, you see that we continue to have a drop in local distribution zone, residential tertiary. For power generation, significant drop, but a rebound in industrial demand. This is in line with the question asked before. A rebound in industrial demand, you can say that it is rather small because you have to look at it in terms of the historical average. We are still far below the historical average, but this is, yes, a rebound compared to the other sectors. We don't have the exact answer about the sector that are behind, but what you can say is that if you compare to what is happening in Asia, for instance, you can say that refiners or petrochemicals, some sectors that are sensitive to oil prices, those sectors are seeing a rebound in gas demand. Just to know, these sectors are also the ones that destroy a lot gas demand in the previous months and years. So you can explain this by just come back to a normal situation where refiners and petrochemicals are increasing again their gas demand. So the situation is still very comfortable, as you can see it on the storage situation. End of last year, we were at 92, far above the 8% given by your answers. And since the start of this year, we are still very comfortable, as we can see it on the next slide. But what the question we are asking here is to know if the fact that stocks are comfortable enable us to think that we can go calmly ahead of the coming months. The market is answering by saying that there are a lot of risk factors. You have some of them mentioned here. The US LNG supply, Russian pipeline flows through Ukraine, tension in the Middle East. I didn't mention the 26 BCM we are still receiving from Russia. Half of this volume is coming from Ukraine. This is the Russian gas transiting through Ukraine to European countries. So let us say 13 BCM. These 13 BCMs could be at risk in the very short term because of the attacks made by Russia against some Ukrainian facilities. And in the medium term, these volumes are at risk just because the transit agreement between Russia and Ukraine will end at the end of this year. The most likely scenario is that those flows will disappear at the end of the year. So yes, on one side, you have a comfortable stock situation, but on the other side, you have a lot of risk factors, and probably this is what is preventing the market to be completely calm and to continue to exert a downward pressure on gas prices. So prices were clearly down since, let us say, November. You can see it on the two graphs. On the left, you have the TTF month ahead. On the right, the calendar 2025. So downward trend since November. And this downtrend ended, let us say, at the start of March. And in March, prices were rather stable. We were in a kind of equilibrium. This equilibrium was, say, a fair balance between the comfortable spot situation and the main risk factor we mentioned. But this equilibrium shifted upward from early April. Some risk factors are mentioned here. You have the drop in US gas production. But if you have a drop in US gas production, at the end you can have, you can imagine a drop in the US LNG export, major risk factor for Europe. You have, I mentioned them, the attacks from Russia against Ukraine, and you have as well the drop, the unplanned the non-expected drop in US feed gas to the Freeport LNG terminal. So meaning that we could also have a drop in US LNG export, and particularly to Europe. But the rise intensified last week with the tension in the Middle East, tension between Iran and Israel. What the market is fearing now is clearly a retaliation from Iran, deciding to close the Strait of Hormuz, for instance. This is a major element for the global LNG market, because around 20% of the global LNG supply is transiting through this Strait of Hormuz. Namely, this is mainly the flows from Qatar towards India, China, and South Korea mainly. So if you close the Strait of Hormuz, this means that those countries will have to recourse to other sources and then tighten the global market. So this explains why the market shifted upward. You can see it clearly from the graph. Month-side prices, they rose close to their 1 year average, but they didn't reach it. This is an important message for the market. They didn't manage to reach and to break the resistance of the 1 year average, meaning that so far the comfortable spot fundamentals are still the winners. So they still maintain prices in a downtrend. Yesterday, prices drop again, but remain close and slightly above their 20-day average. What does it mean? It just means that, yes, the market is ready to buy the fact that fundamentals are comfortable. The risk premium on the Middle East tension is falling. So it's normal for prices to drop, but the market is not comfortable enough to take a much stronger stance on the downside, meaning pulling prices below the 20-day average. So maintaining them around this 20-day average is a kind of wait and see position. We don't know yet what will happen. And particularly as so far, yes, Europe is still receiving important LNG volumes, but we are heading toward the summer, and Asia will have to buy more LNG for the peak power demand during the summer. So the market is also afraid of a drop in European LNG supply in the coming months, which would, of course, reduce the comfortable situation we have on the storage levels. So having said that, of course, now we can build some scenario just to imagine what would happen in the coming months. For this scenario, for these scenarios, we just maintain for some supply sources the volumes we had in 2023, the case for Russia. But as I mentioned, for Russia, you have to be careful. For this year, yes, you are almost sure to have this 26 BCM until the end of this year. But for next year, you have to take just half of this volume, because in our central scenario, we believe that the transit via Ukraine will stop. For Norway, we are just coming back to the level of 2022, so slight increase compared to last year. Domestic production, slight drop, and stable volumes for North Africa and Azerbaijan. So the main risk factors are on demand and LNG supply. That's why on the table side, you see the various scenarios. For demand, the central value is just the value of last year, and then we assume that we can continue to reduce demand by 5%. This explained the 353. And otherwise, if you assume a rebound in demand, as was the case for industry, if you say that, yes, what we are seeing for industry, for instance, could be sustainable, you can push demand higher, for instance. You can also imagine a drop in renewable generation, meaning that you have a rebound in gas demand for power generation. So this is for demand. As for LNG supply, for the central value, we did not take the value of last year, just because we are quite sure that for this year, Europe will have less LNG. So the central value assume a slight drop compared to last year. And the value of last year, the 144, we take it as a maximum. And then you can imagine a worst case where you have a strong drop in LNG supply. So having said that, you have all the scenarios, and then, as usual, you can take three of them that have, in fact, that are taking in account all the likely outcomes, from scenario 1 to scenario 3. Via the scenario 2, you have all the outcomes. Important to note that scenario 3 is not a sustainable equilibrium, just because this value is above the storage capacity you have in Europe. You should be around 110 BCM. So this just means that if the market was to reach this scenario 3, you will have to trigger a rebound in demand or a drop in LNG supply. Drop in LNG supply could be via a drop in global LNG supply. For instance, if you have a drop in US LNG supply, meaning that, of course, at the end, you'll have a cut to the flows to Europe, or you have a diversion of LNG from Europe to Asia, for instance. This diversion from Europe in Asia just show us that in this market, the two zones for the LNG market that are the most important ones are clearly Europe and Asia. And you'll see it on the next slide. Here we try to build a kind of LNG global supply demand balance, starting first with the table which show what happened in the four main Asian countries in the previous years. They are Japan, South Korea, China, and India. You look at what happened in 2022, you see the strong drop in China LNG import, drop again in India LNG import, while have a kind of stabilization for Japan and South Korea. So these countries, China and India, are clearly the most price sensitive ones. This drop in 2022 was followed by a strong rebound in 2023, just because prices drop at that time. So we'll use this feature of these two markets to build our scenarios. So in the table below, you have the global supply demand balance. We start with the four main countries, and we assume that China and India will continue this year and next year to increase their energy imports. And this will offset the drop or the slight drop or the stabilization we expect for Japan and South Korea. What will enable this increase is clearly an increase in supply. And this increase in supply, you see on the table, is mainly coming from the US. Again, this is a scenario. If at the end you have a slow increase in US LNG export, for instance, because energy prices are too low, you have a cut in production, you can end with a volume which is weaker compared to what we are showing here, meaning that the market will have to adapt. But we assume as a central scenario that this volume will come from the US, enabling the global energy supply to increase, enabling China and India to continue to increase their LNG imports, and also enabling Europe, as you can see it on the row for European Union plus UK. You see the assumed increase in LNG supply in LNG imports in 2025. This is important Think about what I just said about Russia. We expect the end of the transit via Ukraine, meaning that we expect to lose for 2025 around 13 BCM. So having this increase in LNG supply will enable Europe to offset the drop expected in the Russian LNG, the Russian pipeline flows. So we put some numbers for China and India, yes, but behind those numbers, what is important is to explain why, if needed, China and India can offset their LNG imports. Here we just show how they are doing it. They are doing it because they have coal. This is particularly true for China. As a reminder, in 2022, when gas prices surged, China reduced its gas demand. And this explains also the strong drop we saw at that time for LNG import, knowing that they also have the possibility to increase domestic production or to increase their pipeline imports from Russia via the power of Siberia, for instance. And when prices dropped in 2023, you see that gas demand rebounded. Coal is the energy source they use to modulate their LNG imports, in fact. So at that time, they needed to switch and to destroy some gas consumption. They increased coal production in 2022. And in 2023, when it was less needed, when they could at that time move again to the LNG market, they reduced the coal production. For this year, they expect to reduce coal production just because they find some oversupply, but also they are under pressure from some safety concern. They had a lot of fatal the casualties in some coal mines last year. So this year they decided to reduce their coal production by 4%. Despite this drop, we don't expect the coal market to be tight, just because when you look at what is happening in some top order producers like Indonesia or India, coal production is expected to rise this year. I think that Chinese authorities know that. So the decision to say, okay, we'll accept to reduce our coal production just to take more in terms of imports, they have in mind that they will have the possibility to do that at low prices. But you believe that if it is not the case, if the coal market were to tighten, they could reverse that policy. They did it in the previous years. I believe that they should continue to do it in the months to come. So this is for China. You have the same for India. As for China, India has also the possibility to use more coal. It was clearly what was done in 2022. You see the strong drop in gas use for power generation at that time, just because they move from gas-fired generation to coal-fired generation. But in addition to coal, they have also some possibilities on the oil side. Here, I already show it in the European case, but here you have an illustration for India. You see the strong drop in gas consumption in refineries, in petrochemicals in 2022. And when prices drop in 2023, you see the rebound. You see it as well on the graph. There was a rebound in gas demand in those sectors. So I believe that they should continue to do that. And this one, I will take the opportunity for this one to answer one of the questions that was asked regarding the correlation between oil prices, coal prices, and our gas and power prices. So this illustrates how the correlation works. when gas prices increase too much in 2022, you have a lot of gas demand destruction, first because of efficiencies and so on, but you have also part of the destruction that was linked to energy substitution. So this illustrates the energy substitutions in favor of coal, for instance, and also in favor of oil. This just means that yes, in a very short term, gas prices can move above coal or oil prices, but in the long run, you are triggering some substitutions in favor of coal and oil that in the long run exert a downward pressure on gas prices. Though having gas prices in particular above oil prices is clearly not sustainable in the long run because of the possibilities of substitutions. So where can prices head now? Here you have two graphs, both on the TTF month ahead, but also on the calendar 25. So I talk about prices remaining below their 1 year average, just because this is a kind of equilibrium, the bearish fundamentals exerting a downward pressure. Do we expect the prices to remain below this 1 year average until the end of the year? I tend to answer yes. And to link this view with the view on stock levels, you can just translate the stock situation to prices. Scenario one, if you remember well, we have a tight stock situation, stock falling to around 51 BCM, relatively low levels. So this is clearly a tight scenario with prices moving above their 1 year high. It is important to notice that this 1 year high is above the Brent price. What I just said was that in a normal situation, with all the energy substitution, gas prices should not exceed oil prices. So in scenario one, of course, prices are above the Brent price, meaning that you are in a very tight situation. And even the substitutions in favor of oil are not able to calm down the rise in gas prices. They could in the long run, but in the very short term, no, they cannot. You are in a hurry to buy gas. You cannot trigger all the substitution you want in favor of oil. You can be above the Brent price. You are moving above toward the 1 year high. And you can even, in the very worst case, move to the gas oil switching level. Gas oil switching level is clearly the last one to trigger, because here we are talking about using some diesel enzyme for power generation. So this is for the worst situation. When you look downwards, you maintain the prices below the 1 year average. So you are in scenario two, but you are above the 1 year low. The 1 year low, it is important to notice that on the month ahead side is above the US gas price delivery to Europe. So this is the short-run marginal cost. You are taking this into account, the shipping and the regasification. You cannot expect prices to drop below the green line for sure, because it means that if it is the case, you'll have a cut in US LNG export to Europe. So I will say that my best bet is clearly prices remaining below the 1 year average, but still above the 1 year low. Clearly, we are in scenario two, and we are not comfortable enough to move to scenario three. This is true for the month ahead, and you have as well roughly the same for the calendar contract. Last slide is about the global view through 2030. We believe you can still have some downside potential on the spot and the near curve. Just because when you look at the TTF price orange line, you are still above the US price. So if the market remains comfortable, you can drop down to the US price. But for the long term, it will be difficult to reach this downside potential, because I believe that the US price will be a strong support level. A strong support level, because you cannot avoid, if prices drop too much, to have a cut in LNG export to Europe. And even for the coal price, you have to be careful. Here, what is shown is the coal switching level for power generation in Europe. I believe that this level will be less and less relevant for Europe, just because coal is being phased out. But more and more, you'll have to find another indicator for coal, which is coal for Asia, for instance. For Asia, as I said, for China in particular and India, there is a strong competition and substitution possibilities between coal and gas. So coal prices will tend to continue to set a floor for gas prices, because if gas prices tend to drop too much below coal prices, you'll have a reverse of the policy in China, for instance. They will say, okay, gas prices are too low, we increase our gas consumption just to save some coal production and also save some lives in mines. So to me, the two elements, US LNG, the US LNG price and the coal price, will tend to set the equilibrium for gas prices in the long run, meaning that the downside potential could be limited in the far curve. So that's it, Julien. I don't know if you have some questions for me.
Yes, Severis, thank you for your presentation. We have some questions, but we are a bit late, so we'll try to go as quick as possible. First question, I would say a global one. What do you see? What is the impact, according to you, of the replacement of Russian pipeline gas by LNG on the TTF price levels and volatility?
The easy one is clearly on the volatility. If you have a pipeline gas, you know that the pipeline cannot be diverted, for sure. For LNG, it's not the case. So LNG is creating a competition between Europe and the other buyers, in particularly Asia. So the LNG dependence is making Europe more dependent on the Asian market, on the global market, meaning more volatility for sure.
All right. Second question, you already mentioned it, but maybe just to sum up it again. What is your outlook on Russian gas flows to Ukraine and Slovakia after 2024 and the expiry of the transit contracts between Gazprom and Ukraine?
Yes, we already mentioned it. So in our base case, we believe that the transit from via Ukraine will stop. So you have to replace those volumes via LNG.
All right, thank you. And one last question. Regarding Russian pipeline flows to Asia and China, what is the current level compared to historical flows to Europe? Is there a long-term expectation that Russian pipeline flows to Asia will grow to match or exceed the lost exports to Europe? And will it reduce Asian LNG demand and rebalance the global market?
Yes, when you say LNG demand in Asia, it's mainly to Asia. So there is the power of Siberia. Last year, I guess they flow around 2020. They flow 22 BCM. The max capacity for the pipe is 36 BCM per year. It is expected to be reached soon. I don't know, the next year, I guess. So this is one. This is not replacing the flows to Europe. Some flows are still missing, but you have to know that they are thinking about the power of Siberia 2, which is around 50 BCM per year, also strong volumes. So with power of Siberia 2, say yes, you come back to volumes that are not replacing fully the volumes to Europe, but at least a significant part of them.
All right. Thank you, Évariste. So let's move on to the last part of this presentation on power and emissions. So a short poll to start again. So EUA DEC 24 prices jumped from 51 euros per ton to almost 75 euros per ton at the highest over the past 2 months. So do you think it's the beginning of a new bullish trend or a temporary rebound before a drop back towards 50 euros per ton, or a temporary rebound before a drop below 50 euros per ton? I give you a few seconds to vote. Yeah, we see clearly a large majority of answers for a temporary rebound before a drop back towards 50 euros per ton, which appeared as some kind of support level over the past few months. So, Etienne, let's see what you think about that for the last part of the presentation.
Yeah, quite an interesting results of the survey, and quite oriented as well. So yes, thank you, Julien. Hello, everyone. So I guess at this point of the presentation, you must realize that we are in a quite complex situation for energy prices, which would be from the macro side, with everyone waiting for clarity on the expected rate cuts, or in the gas markets, which seems to be torn between a comfortable short-term balance and risk of escalating geopolitical tension. So as you will see in the last part of this webinar, the carbon and power markets have displayed a quite sharp volatility as well over the past weeks, and are currently driven by a mixed bunch of drivers, to say the least. But let's start right away with a global view of the market fundamentals, and as usual, starting with the demand. So as you can see on the left chart, the power consumption in Northwestern Europe, and mostly in Europe, have experienced a blatant lack of recovery over the past months. It was induced by 2 factors. First, of course, the particularly bearish weather, and it's highlighted by the right chart with the residual demand. So you can see that residual demand, which is the power consumption once deducted the renewable production, has lingered well below average during the winter. It's part due to the temperatures, which were on average 2.4 degrees Celsius above normal for the first quarter of 2024, which is absolutely significant. And of course, we had a quite strong renewable production, which I'm going to talk about later. And it has an impact on the average power load as well, because it also impacts the behind the meters renewable production. So all the, let's say, solar capacity and a bit less wind capacities that are not connected to the grid. And then it translates in lower demand. So we have had bearish weather over the past months, but meanwhile, we also have a still structural demand, basically corrected from temperature aspects, that lingers close to 2023 level. And this structural demand, let's say, represents a bit better the industrial activity. And you can see that it has lingered really close to 2023 and still well below historical averages. Basically, it shows that the industrial activity has not recovered, only marginally recovered from the energy crisis, and shows that the demand overall remains very weak. According to RT, of course, the structural demand remains 8% below normal, which is quite substantial, and you can absolutely extrapolate this level to the neighboring countries. One thing to note for the upcoming weeks, however, is that this correction is more reliable during the winter season, when we have a strong correlation between temperatures and power demand, especially in France. But when temperatures got closer to 15 degrees, it's much harder to have a reliable correction. So you might see some divergence from the structural demand showed by RTE on this chart and the actual real level of demand. Let's have a focus on the industrial side. So Olivier already talked a bit about it, but you can see that the industrial production has really collapsed again at the beginning of 2024, which means in terms of growth compared to the previous year, we're still below zero. And thus, we still have a weak demand and weak emissions, which will impact, of course, EUA prices. Now, if you want to have a look forward, you look as usual to the manufacturing PMI, which is a good indicator of the, let's say, business sentiment. And you can clearly see a relapse in the first months of 2024, which suggests that we will continue to see a contraction of industrial activity in the coming months, and the recovery is still not in sight. Now, regarding the supply, not much surprise there, but I want to draw your attention on one point, which I'm going to talk about later. So first, regarding the solar generation, you can see that the production is soaring again. We are above the previous years due to the massive installation of new solar capacity. About 63 gigawatts of additional solar capacity is scheduled to be installed in Europe this year, which is quite massive, of course. Regarding the wind generation, it's more volatile. We had a bit, on average, lower production in March, but we had very strong wind events followed by a wind shortage. For instance, in Germany, it was actually a standard to see a production at 40 gigawatt hour per hour one day and plummeting to 5 gigawatt hour per hour the following one. So it's a very strong volatility, and you can guess quite clearly the impact on the power spot prices it could have. But what I wanted to draw your attention on is the hydro production, especially in France. You can see that after the summer drought of 2023, the production has been quite strong since mid-October. And this really had a strong impact on French power prices and overall market, but you will see better on the spot prices. Regarding, sorry for the sound behind me. Regarding the French hydraulic reserves, we had a bit of a drop early January due to the temporary cold spell at the moment, but otherwise levels are above normal. And we have even seen a quite good increase at the end of March and early April due to particularly wet conditions. Moving to the nuclear situation in France, a bit of news. First, we have seen a quite strong improvement of nuclear availability, which is in the upper chart. You can see that instead of following the usual decrease and seasonal decrease in the first quarter of the year, the availability of EDF fleet have steadied, which is quite a good news. We have a bit of development regarding the corrosion issue with, I'm sure you have all seen about it, the corrosion issue detected at the Blaye 4 reactors and more recently at the Paluel 2 ones. But they actually came with at no surprises because those units were already identified as risky. The Blaye 4 reactor has already been fixed. And we don't have much news on the Paluel 2 one, but it's actually has quite weak impact on prices because, and this is what's interesting about nuclear production at the moment, due to the very poor demand and very strong renewable production, EDF is forced to modulate quite strongly its nuclear production to leave room for the renewable production. And you can see it quite clearly when you compare the actual generation from the availability. So you have the availability in blue on the upper chart and the generation in orange. And you can see that usually, and that was the case during the winter, EDF produces as much as it can. But more recently, in March and April, due to the very warm temperatures and quite strong renewable production, actually wind events and solar ones, you can see that EDF dropped, actually reduced its production by up to 20 gigawatts for a day, which is quite massive. And that is why the new corrosion issue detected at Paluel 2, also already, of course, identified as risky, so not which did not trigger a panic attacks, had even lesser effect on prices because we have plenty of nuclear for the actual demand. Moving to prices, and in my opinion, this is the most striking chart of this part of the presentation. So you can see that prices were quite correlated and quite close over the first quarter of 2024, but over the past weeks, the French prices have decorrelated quite strongly from the rest of NWE. And this can be explained by several factors. First, of course, as I said before, we had a very, very strong hydro production and improved nuclear availability. Second, we have also a weak structural demand, but another item that also accelerated the decorrelation of French prices from the rest of NWE is the Spanish prices, which you can see in the purple dotted curve. You can see that even though French prices are already low, Spanish prices are even lower due to massive production of solar and, more importantly, hydro production as well. And this has led to the situation displayed by the right map, which are the border flows from France to the neighboring countries. And you can see that even though France has already very low prices, it still imports from Spain, which has even lower prices, and instead, conversely, export to the neighboring countries. And this has also had an impact on the forward curve. Because if you look at the red chart, which is the French forward curve and its evolution over the past weeks, you can see a quite strong decorrelation between short-term contracts, for instance, May and June, and the winter contracts. You can see in September and October, but also for the Q4 and Q1 25. That means that the front of the curve is basically dragged down by the very low clearing of the spot market and very comfortable, to say very loose balance of the power market. But on the other hand, the later part of the curve, so basically the winter months, are they are supported by a rebound of the fuel basket. And so you are really seeing a divergence of drivers along the curve. And that's very interesting. On top of that, we have seen a very record level of spreads between France and Germany power prices, which are displayed on the right chart. You can see that the spread for the front months, so for May, has reached records recently. And it's quite massive due to the oversupply in France. But it's also displayed on the later part, also on the calendar contracts, and this time it's more attributed to the improvement of nuclear generation in France, especially with the end of the corrosion issue planned for early 2026, while in Germany, the power capacity is progressively reducing because, as you all know, Germany decided to exit from their nuclear production. They have no longer any nuclear reactors, and they are progressively exiting their coal and lignite power production, which means on one side, you have improved capacity in France, and on the other, you have progressively reducing thermal capacity in Germany. Also, of course, it's partly compensated by the soaring renewable capacity. And that is why we are seeing such a discrepancy between the two countries, while historically, French prices, especially during the winter, were higher than the German ones. Moving to the back end of the curves of the forward prices, which are often considered as a benchmark for the power market, the calendar prices, sorry. There was not much news on that front. Basically, the calendar prices tracks the rebound of gas and carbon prices, and even coal a bit before that, so around February. Not much news. You can see a keep strong correlation with the fuel and emissions prices. And when you look at the current state of the curves, you can see already what I talked about, so a strong impact of the short-term prices on the front of the curve, and later dated contracts more influenced by the fuel basket. Which leads us to our outlook. So, in our opinion, the recent gains were driven mostly by short-term drivers. And by that, I mean geopolitical worries. Evariste already talked to you about it. Temporary incident on US Freeport LNG facilities and an unplanned outage in Norway. Also some strong short covering in the UTS, but I will talk about that later. And a temporary cold spell that we are currently experiencing. But all of that are very temporary drivers. But if you look at the fundamental picture, it remains quite comfortable. We have still historically high gas stocks. We have a particularly strong renewable production, and even more with as days gets longer. So we should have rising solar generation, especially with the increased capacity again this year. We have high hydro stocks in Spain and France. And we have a lingering demand destruction, which seems to be here to stay. So all of that concur to say that we expect a correction from the recent bullish run. But on the other hand, we see the downside potential. So basically, the chance of seeing prices drop below their level in February has quite reduced for several reasons. First, in the UA market, we have seen some opportunistic buying materializing where prices fell below 60 euros per ton, which hence should provide support to the market, to both markets actually, if prices correct to that level. Second, as Évariste told you, we are seeing slight signs of rising competition from Asia on the LNG market. And as you all know, the very large supply of LNG over the past month has concurred to the downtrend of energy prices. And finally, we still expect a recovery in industrial activity at some point, even though it could take longer than expected, and it should materialize by higher power demand and thus start to support prices. So overall, we expect a correction in the short term, which has actually already started to materialize in the past 2 days. And after that, we are seeing an asymmetrical risk biased to the upside, because the main risk, in our opinion, is to see the tension in Ukraine and Middle East escalate, which could eventually impact the gas supply. It's not taking this way, but it's a very strong risk and could push energy and especially power prices higher. Otherwise, it's quite usual drivers to monitor with the weather, of course, and any, let's say, more standard issue on the nuclear or gas supply. Regarding EUAs, which will be much quicker because there was not much development on the carbon market, actually. So the main news was, of course, the publication of the 2023 verified emissions report, early April. We showed that emissions stood at 1.15 billion tons in 2023, which is a substantial 15.5% reduction from 2022. It was not really a surprise. We were all expecting it, but it's still quite a massive reduction from the previous year, mostly attributed to the power generation. You can see that the sector experienced a 24% reduction in its emissions due to several factors, basically a partial switch from the coal to less emitting gas prices as the gas prices started to drop. We have also a weak demand due to the demand destruction from the energy crisis, and improving nuclear availability in France, and of course, soaring renewable capacity, which reduce the needs for the thermal power plants and thus the emission of the sector. In the industry, we witness a 7% reduction, which does not seem impressive when you look at that, when you compare to the power generation, but in reality is quite substantial because, as you can see on the upper chart, the emissions for the industry tend to remain quite constant because we have not reached a higher level, high enough level of carbon prices to trigger massive carbon abatement investments. Sorry about that. And that is why so far industry has been buying massively allowances instead of reducing its emissions. So experiencing a 7% decrease of emissions really highlights the contracted activity of the sector over the past months. Conversely, in the aviation, we are seeing a 10% increase, which is not, of course, surprising. It's only a progressive recovery from the COVID period crisis. So all in all, this represents a 47% reduction of emissions from 2005, which is very well aligned with the 2030 target of 62%, which you can see on the upper chart with the red target. And the only things to note regarding this report is that only 94% of installations have surrendered their emissions report so far. So you could see a slight change in the, let's say, final data for 2023. But overall, we expect an emissions reduction closer to 16% from 2022. Regarding prices now, not much development as well, despite a very sharp volatility. Basically, we have seen carbon prices rebounded as well since early March, and it was due to two things. First, the gas market, of course, which shared a very strong correlation with EUA prices for a lack of stronger fundamental driver. Since the supply is already defined and the demand is showing no sign of recovery, well, it's all it falls on the end of the fuel markets. But we also have seen the investors reduce progressively their short position, which is highlighted by the black dashed curve. So while they are progressively covering their short, of course, it tends to support prices. But the most surprising part of this chart is actually the later part, because you can see that prices sold by nearly 15 euros per ton in less than 2 weeks. And we were expecting it to be attributed to a sharp short squeeze. So basically speculators buying back most of their short position. And instead, you can see that the latest report of commitment of traders showed that the position of speculators remained quite steady. And it's quite surprising. But it could be caused by two things. First, there could be two kinds of investors, some with very short-term view betting on this short squeeze and hence increasing their lengths. And on the other hand, short investors actually covering their short or rebuilding back with a more long-term view. On the other hand, in my opinion, a more reliable assumption, it could be caused simply by option hedging, which could be quite transparent on the actual net position, but could induce a bullish momentum in EUA prices or are actually fueling it. And I end with the EU ETS outlook. So what can we expect in the coming weeks regarding CO2 prices? And well, the recent bullish rally of carbon prices, as I said before, seems hardly sustainable, mainly because it was driven by short-term factors, such as, similarly to the power market, such as rising worries in the gas market, but no actual significant change in balance, and of course, option hedging from speculators in the EU ETS. But if you look at the global fundamental pictures for the year, it remains actually unsupportive for EUAs. Indeed, we still expect higher supplies compared to 2023 due to the REPowerEU plan, which will front-load auction volume from 27-2030 to 23-26 until August 26. We will have lower MSR withdrawals this year due to the progressively reducing market surplus, and we will have, of course, the partial compliance of shipping despite a full adjustment of the EU ETS cap, which mechanically will increase the supply of the market. The demand side remains particularly weak, as I said before, due to particularly contracted industrial activity, rising renewable capacity, and improving nuclear availability. Moreover, you will have to monitor closely the EU Parliament election in June due to the emergence of populist parties with, let's say, a less environment-friendly agenda. So this could lead to a higher risk of the European Commission taking a step back in its climate ambition. And so all of that concurred to say that we expect prices to strongly correct, and the 75 euros per ton was only a temporary volatility event rather than the beginning of a new uptrend. And as you all said in the survey, we as well expect a correction toward first the 60 euros per ton level. And if the demand remains very weak and gas prices start to fade again, especially on the prompt or even on the longer term, we could see prices drop back below 60 euros per ton and toward 50 euros per ton. On the other hand, and similarly to the power market, we expect prices to drop below that much less likely. Why is that? Because there's still an anticipation of demand recovery, and the EU ETS is an anticipative market before anything else. So participants might be reluctant to take a strong bearish bet, especially if prices drop back to 50 euros per ton. And on top of that, and I already mentioned it before, there was some opportunistic buying emerging when prices fell below 60 euros per ton, which means that emitters are starting to find prices attractive below that mark, which thus, of course, limits the downside potential. And that's about it for power and carbon prices. Do we still have time for some questions?
So we have a few seconds before the end of the session. So I'm just launching the satisfaction survey, and I will take the question during the survey. So please take a few seconds to answer this poll, to rate the webinar. It's really important for us. So a question for you, Etienne, regarding the power flows between France and Germany. Have you noticed any restrictions on exports, on power exports from France to Germany? I think that could explain the divergence of spot power prices between those two countries.
Well, the first restriction is, of course, the capacity. There is a limitation on the capacity to export power from France to Germany, and it's not that high. I think in total, France can export about 15 gigawatts of electricity to its neighbors. So it's enough to keep a spread between the two countries. Otherwise, of course, we can have some physical restriction on the grid based on the flow base and everything, but it's very technical. I must say I'm not really an expert on this particular part of the market. So I haven't experienced or seen anything particular regarding this. But I think, in my opinion, the main explanation between the spread is, of course, Spanish, which cannot be moved to Germany directly, while in France, France receive power from Spain and hence benefits from the very low prices of the country. And of course, the limitation in the power export from France to Germany, keeping the spread between the two countries.
Okay, thank you, Etienne, for that. So it's time to close this webinar session. So thanks to those who took the time to answer our survey. We'll see you again in July 24 for the next webinar session. So I hope you enjoy this one and see you soon on our EnergyScan platform. Goodbye.